Japan's economic story is often described as a miracle. From the ruins of World War II, the country rebuilt itself into one of the most productive and technologically advanced economies in history. By the late 20th century, Japan had become a symbol of efficiency, industrial discipline, and long-term planning. Yet miracles rarely last forever. By the early 1990s, the engine that once powered Japan's rise began to stall. Growth slowed, confidence faded, and an era of stagnation quietly replaced decades of expansion. For decades, Japan's growth model relied on exports, industrial coordination, and high savings. Corporations reinvested profits. Banks funneled cheap credit into industry. The government guided development with precision. This system delivered extraordinary results, but it also created structural imbalances that remained hidden during periods of rapid expansion. In the 1980s, loose monetary policy flooded the economy with liquidity. Interest rates stayed low. Credit became abundant. What was intended to stabilize growth instead fueled speculation. Capital drifted away from productive investment and toward financial assets. Asset prices exploded. Real estate values soared beyond economic reality. Stocks detached from fundamentals. Wealth appeared limitless, but it was built on inflated expectations rather than real productivity. Japan was not growing stronger, it was growing fragile. When the bubble burst in the early 1990s, the damage was severe. Asset prices collapsed, balance sheets imploded. What followed was not a recession, but a prolonged adjustment unlike anything Japan had experienced before. Japanese banks were left holding massive amounts of bad debt. Instead of allowing failures and restructuring, losses were hidden. Insolvent institutions survived, but they stopped lending productively. Credit froze without collapsing, creating paralysis rather than crisis. Confidence evaporated. Consumers saved instead of spending. Businesses delayed investment. Economic momentum disappeared. Growth did not crash. It slowly faded. The government responded with stimulus after stimulus. Massive public spending prevented collapse, but failed to restore vitality. Debt increased while productivity remained stagnant. Demographics worsened the problem. Japan aged faster than any major economy. Fewer workers supported more retirees. Consumption weakened. Innovation slowed. Rigid labor markets discouraged risk-taking. Lifetime employment preserved stability, but reduced dynamism. New firms struggled to emerge. Deflation became persistent. Falling prices discouraged spending and investment. Monetary policy lost effectiveness. While the world adapted to globalization and digital transformation, Japan moved cautiously. Stability replaced growth as the primary objective. Later reforms attempted to restart momentum, but structural damage accumulated over decades could not be reversed quickly. Japan did not collapse. It stabilized at a lower trajectory. Stagnation became normal. The lesson is not failure, but trade-off. Japan chose control over creative destruction. Economic systems age. Without renewal, even the strongest slow down. Japan's economy did not stop growing by accident. It followed a logical path shaped by policy choices, demographics, and risk aversion. Growth ended not with collapse, but with quiet exhaustion.